Good morning, good afternoon, good evening, however this video may find you. This is Cole Strange here from Movement Mortgage once again saying hello and here with my partner in crime, Mr.
Chris Cervantez
Cervantez.
from eHomes.
And today I wanted to do a video on multi-unit properties. This is something that you had expressed interest on, and this is something that I have some knowledge on, not only as a loan guy, but also as somebody who owns a couple of multi-unit properties. So I wanted to go over briefly what the different programs are that you can utilize for this. But I'm excited to share some info with you today how to find a good property. Chris helped me buy a fourplex. It'll be 3 years next month. That property now cash flows and not only pays for the mortgage, but also spins off a little bit of income for me each month. So it's not easy to do. You have to have a great real estate agent. And fortunately, that's what Chris is. So here are the three loan programs that can be utilized to purchase a multi-unit property. The first is an FHA loan. Okay. FHA loans require a minimum of 3.5% down, which is nice. These are good for single family residences and duplexes. I'll talk about why I don't like these as much for triplexes and fourplexes or 3 and 4 unit properties in a second. But these are nice because the credit requirements for FHA are a little bit more lenient than they are for conventional. So if you're somebody who's like, hey, I want to get in the game, but I've got a credit score maybe in the low mid 600s, which is tough to qualify for conventional financing. FHA is a great option for you. It's also a little bit less down than what's required for conventional. Conventional requires 5% down. FHA requires 3.5%. So a little bit less, which is also nice. I like these for duplexes. The reason I don't like them as much for triplexes and fourplexes is that they are very difficult to qualify for. And what I mean by that is FHA loans have a self-sustainability test. I don't want to get super technical here with you, but long story short, the rents from all of the units on the property have to cover a certain percentage of the mortgage payment. And in my experience, particularly LA County and surrounding counties, even counties up in Northern California, it's really difficult to get enough rent for the property to qualify utilizing FHA financing when it's a triplex or fourplex. They have to pass that self-sustainability test. In most cases, properties with that much cash flow typically get picked up with cash by an investor. I'm not saying it's impossible. I'm just saying I've been doing this for 9 years, and the only time it's ever worked for me was a property way out in 29 Palms, which is like in the middle of nowhere, Southern California. Not impossible, but just very, very difficult for triplex and fourplexes with FHA. I like FHA for duplex purchases. Chris, not sure if you have any insight on that.
Yeah, so just to clarify, because I think a question that's even just popping up, and I want to make sure that the buyers are understanding, is that single family and duplexes do not have to pass that self-sustainability test, correct?
Correct. That's what, yes, exactly.
Okay. It doesn't matter what the rents are on that other unit. Granted, we're talking about, I guess, more focused on that duplex.
Right.
Now, with regard to the duplex, can you get into what if the duplex that they're considering has a long-term tenant in place and it's, market rent is showing $2,000 and maybe they're only renting it out for $1,000. Is there pros and cons to that, or can you speak to that a little bit?
Yeah, definitely. Obviously, the more rent that you can get, the better. But more often than not, there's going to be at least one tenant in place when you're purchasing a multi-unit property. It's very rare that you purchase a multi-unit property and all of the units get delivered vacant. Typically, you're going to have at least one tenant. So In that scenario, when the property has a tenant in place, the rent that is used to qualify is the rent that the tenant has contractually with the existing landlord. So you, as the purchaser, you take over that contract that was already in place with the previous owner. And that's the income that the lender is going to be able to use to help you qualify. And we can use 75% of that. So if you're getting $1,000, the lender is going to be able to use $750 in order to help you qualify. And the reason for that is inevitably things happen, right? Tenants don't pay, tenants are late, maintenance needs to be done on the property. If you get $1,000 from a tenant, very, 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 very rarely are you ever just going to put $1,000 into your pocket. Happens on some months, which is nice, but on average, usually end up taking 25% of the gross rents that you receive from a tenant, and that's what can be utilized to qualify.
Nice, nice. Thanks for clarifying that. And then with regard to in the event that it is delivered vacant, on the off chance, what would we do in that situation?
So in that case, you can use market rents, and the appraiser that goes out to the property is going to fill out a form, and they're going to do comparable rents, just like they do comparable sales for the value of your property. So they're going to look at the property, they're going to give an opinion of value for the property, but in addition to that, they're going to say, okay, let's look at some other duplexes in the area. What are more recent rents that have closed that are on the MLS? And they're going to use that for a comp to figure out what the rental amount is for the market. And then we can use 75% of that. So if the market rent is $2,000, then we can use $1,500 to help you qualify for that mortgage. So obviously, more rents, the better. That's also going to help you qualify, which is one of the reasons why having a great real estate agent is so important in this process. Is it's not like buying a single family residence where we just go, okay, what's your income? How much can you afford? There's scenarios where you may qualify for a duplex for $1 million, but then you don't qualify for a multi-unit property at $900,000, which seems counterintuitive. You'd be like, well, if I can qualify for $1 million multi-unit property, why would I not qualify for a multi-unit property that's $100,000 less? And the reason for that is we're taking the rents that are coming from those properties into account. And so if the rents on that $1 million property are significantly more than the $900,000 property, you could, in theory, qualify for a house that's more expensive because of the rents that are received compared to the two.
Nice, nice. Okay. And then I guess that's the only questions that I had on the FHA.
Sweet. So moving on to conventional financing, and this is something that's relatively new. Time flies, so don't quote me on this, but I think it's been 6-ish months since this new rule came out. It used to be if you wanted to purchase a multi-unit property and utilize conventional financing on a duplex, you had to put 15% down. And on those triplexes and fourplexes, you had to put 20% or more down, which is, not, multi-unit properties are going to be more expensive. Not a lot of people have we're talking about hundreds of thousands of dollars in this case, right? So not a lot of people, particularly people purchasing their first house, have just several hundreds of thousands of dollars sitting around. So it was really difficult to qualify, but this new rule came out, and you can now purchase a multi-unit property with conventional financing with just 5% down, which is pretty awesome. I like this in particular for triplexes and fourplexes, also duplexes as well, if you've got a good credit score. But I really like it for triplexes and fourplexes because unlike FHA, which has that self-sustainability test, conventional loans do not. These are going to be easier to qualify for because the rents don't have to meet that same tough test that FHA loans have. So before, you're looking at 20% or more down. Now you're looking at 5% down. And it's like much, much more realistic for somebody that's buying their first house to put 5% down. Still can be a pretty penny. You know, if we're talking about a multi-unit property of $1 million, we're talking about 50 grand, you know, which is not no money. It's a lot different than a 3% down payment on a $600,000 house, right? So it's not for everybody, but it's definitely much, much more manageable and it's much more realistic since this new rule went into place.
Nice. And then so again, and I think you kind of open it up the conversation with the difference between FHA and conventional. And just to kind of get to the point, the only reason why somebody would go FHA is that if they have that lower down payment or the lower credit score. So if the credit score is there and then they maybe have that extra couple percent for the down payment, then it seems like conventional is a no-brainer.
Yeah, that's right. On conventional loans, if you've got a good credit score, your mortgage insurance is going to be cheaper, right? So we're talking about, you know, less than 20% down, you're going to have mortgage insurance. And the mortgage insurance on conventional loans is typically cheaper for people with, you know, higher credit scores. In addition to that, on a conventional loan, once your property hits roughly 20% equity, your mortgage insurance will automatically come off. On FHA loans, your mortgage insurance never comes off unless you're putting 10% or more down. So even you could have 30, 40% equity, but if it's an FHA loan, that mortgage insurance is still going to sit on that property for the life of the loan. It never goes off.
Unless you refi.
Unless you refinance into a conventional loan, which is why if you can go conventional, you know, it's always like long term. The goal is to get into conventional financing. So if you can get into it up front, much better for you to get into it up front. But that's, you know, not the case for a lot of people that are purchasing their first house. Yeah, those are the reasons that mortgage insurance is going to be cheaper, and then also it's going to come off when you hit 20% equity.
Yeah, that's good. That's a good thing to know.
Yeah.
Yeah, I think that was my only clarification on the conventional.
Cool. And then for conventional as well, we use 75% of the rents, whether that's rents that are in place or those are market rents. And if the unit is vacant, you know, sometimes it's a mix, right? Like you could purchase a fourplex and maybe 3 of them are occupied. Or, well, by the way, everything that we're talking about, this is for primary residence, meaning you will move into one of the units. Didn't talk about that, but that's really important. We're not here to commit mortgage fraud. FHA is always going to be an owner occupied loan. And then this conventional 5% down is for you to move into one of the units. But let's say you're buying a fourplex and 2 of the units are occupied and 2 are vacant. Sometimes, you know, that'll come up from time to time. And in that case, we'll use the rents that are in place for the 2 units. And then for the 1 unit that you're not moving into, we can use market rents for that one. So it can be a mix of the market rents and current rents, depending on how many units are occupied or vacant. Cool.
Nice.
And then the last way to make this purchase, also for an owner occupied purchase, is VA, which is, of course, you know, my favorite. I'm a vet. Chris helped me purchase a fourplex 3 years ago. And man, so cool. You're a vet, you served your country. One way that you're going to be rewarded is you can purchase up to a 4-unit property with 100% financing, which is crazy, but it can be done. And, you know, no money down is great. Credit score requirements are also more lenient on VA loans than they are on conventional loans. You can use 75% of those rents. Like if you are a vet and, you know, being a landlord isn't for everybody. For me, I tried to do it on my own. And after about 3-4 months, I hired a property management company just because it wasn't worth the time. The tenants that, you know, they have questions, they want to ask stuff, they, you know, they need help, as you know, they should get it. Yeah, VA, multi-unit property, great opportunity. When you get an owner occupied loan, you are stating to the lender that you will live in that property for at least 1 year. For me, I purchased the property in May of 2021. And then I got married in June of 2023. So I moved out after a little more than 2 years of living in the property. And then I rented out the fourth unit that I was living in. And now the property cash flows, which is, it's amazing. For vets that are open to being landlords, purchasing that duplex, triplex, fourplex can be awesome. Could be a generational shift for you and your family. So highly recommend if it's something that you have the appetite for.
That's great. Yeah, a lot of different options. Obviously it's the VA is only available for veterans.
Yeah.
I know a question, and this is maybe a misconception. Oftentimes I'll run into someone that'll say, "Well, hey, my dad was a vet," or "Hey, my boyfriend or girlfriend or partner is a vet. Can we utilize their VA loan?"
So a VA loan is only for a veteran, the veteran's spouse, or another veteran. Like meaning, if you want to have more than one person on the loan, it needs to be the veteran spouse, or another vet. However, if you are trying to use 100% financing, which is the main benefit of using a VA loan, most people that use the VA loan, they do 100% financing. Something that's not as commonly known is you actually can have a brother, cousin, girlfriend, whatever on that VA loan with you if they're moving into the property. But in that case, it eliminates that 100% financing. And now you need to make it comes out. There's a very weird calculation that's used, but it comes out to like 14.3% down payment. So there are some cases where vets come and they're planning on making a down payment of 15 or more percent, and then it works out fine. But in most cases, I've found when they wanted to use their, family members' benefit, it's they're not planning on making a down payment. They want to do 100% financing, and it doesn't work out the way that they wanted it to. So yes, those are the people that can use the VA loan with 100% financing. And then you can, if you're not a vet, but then it requires a down payment, which typically eliminates the plans that people have when they come with that proposal.
Yeah, yeah, that makes sense.
Yep.
Well, that's great. Well, I mean, I appreciate you kind of covering those three options. You guys, if you have questions about what might make sense for you, this is what Cole and I are here for. So similar to how you're watching this webinar or this seminar, we can either jump on a phone call, we can jump on a Zoom, and we can unpack what might make the most sense for you in your particular situation. Something I often tell my clients is, sure, I can find that cash flowing or the high rent 4 unit or the killer duplex that you can utilize FHA financing. But if we don't have our numbers squared away, then we're just chasing our tail. We're just wasting our time. And that's when I'm going to point you back towards a not only a seasoned loan officer, but a savvy investor loan officer like Cole, who can walk you through the steps, help you avoid hours and hours and tons of frustration when it comes to this type of purchase because he's done it twice on his own. So, I mean, he referenced the 4 unit a couple times, but Cole, really quick, can you share the first place that you bought?
Yeah. So the first place that I bought was a single family residence with an ADU, which we actually didn't talk too much about. But it's legally a single family residence. But you can rent out an ADU. So that's what I did. Actually, I bought the house and I lived in the ADU and I rented out the front house. So that was kind of like and it was almost like a little mini fourplex in a weird way because the front house is a 3 bed, 2 bath, and then I had an ADU in the back that I lived in, and I rented out the rooms individually. And then that covered about 75% of my mortgage when I rented out those 3 rooms. So that's a great way for somebody. Maybe you don't have a bunch of money saved. You can purchase a single family residence with the ADU, and then rent out the rooms or rent out the whole house to a family. So yeah, there's a lot of ways to like make this work.
So just for clarification, on that ADU, does it have to be a legal ADU in order to permitted ADU in order to utilize the 75% of the rental?
Um, okay, so you depending on the loan program, you can't use rents on an SFR to help you qualify. That has changed. There are some programs where you can. So it really will depend on like your finances and which loan program we go with. That's actually another more recent change where we can use, if it is a legal ADU, then we can use some of the rents that would come from an ADU. Not always the case, but we can in some case. Like in my case, the way my property is set up, I couldn't use rents. And back then too, and plus it was a VA loan. VA loans, for instance, you can't use rental income from an ADU. So it depends on the program. But yeah, in my case, I wasn't able to use the rental income in order to help me qualify. Fortunately, I was in a spot where it wasn't needed. So yeah, everybody's situation is going to be a little bit different when it comes to that.
Okay. And then, but again, for clarification on that VA, the VA, you can use the rental income if it's a duplex, triplex, or fourplex.
Correct.
It's
Just
not
not
an
if
ADU.
yeah, just not on an SFR.
All right.
Hopefully they'll make a change. They're usually like, try to adapt to what's going on in the market. And right here in California, there's a huge shortage of housing and all kinds of proposals being pushed to make ADUs easier to build and permit and all of that. So I wouldn't be surprised if at some point in the future the VA says, "Hey, yeah, we can use rental income from an ADU," but as it currently stands, you cannot.
Nice. Well, very good. Yeah, I know I was kind of wrapping things up, but thank you
Yeah,
for kind of coming back and I think that yeah, I appreciate you again just kind of going over those things. Let's have a conversation, you guys. I get it. You might have applied or submitted your information to one of those ads that we ran. Maybe because you're in the beginning stages or you're just in a curious stage. It doesn't matter where you're at. Let's have a conversation even if this thing is a couple years out down the road, or maybe even 6 months down the road, let's get a plan together to talk about the strategy involved and to make sure that when the time is right, when that right property comes up, you're going to be ready and you're going to be ready to get a great deal on the property. Any last words, Cole?
no, I think there's nothing to add to that. I think you're right. I've seen many people find the place that they like, they try and rush, make it all happen, and there's something that could have been fixed, 3 months ago that was unexpected mistakes, and they miss out on the property because they're, not ready. So yeah, getting your ducks in a row now, is so important because unknown things can come up, seemingly insignificant things can come up.
All the
So
time.
getting that squared away up front is so important.
Yeah, all the time. Well, very good. Well, again, all of our contact information is below. Please reach out. Let's hop on a call, hop on a Zoom, and we'd love to help. Thanks so much.
Thank you. Bye.